Michael, I think one would have to give President Trump a fair amount of credit for improving generally the business climate and business sentiment in America so far. But you point out that the real worry over trade tensions may not be so much whether it shaves 1/10 or 2/10 of a point off of GDP, but what those tensions do for business sentiment. Explain.
No question, Tyler. You know, since probably the moment that President Trump was elected, going back to the November elections a year and a half ago, markets started to rally. It came as a great surprise to many market watchers. They have continued to rally as regulations have fallen, interest rates have stayed low, and the president has met any number of his campaign promises. The business environment and the business sentiment's been very good. But I think if you look at what's happened on Wall Street just since the 15th, June 15th, which is when the president announced additional tariffs, a $50 billion tariff on China, you know, that begins a tit-for-tat exchange. I slap you, you slap me, and at what point do we turn into some sort of bar-room brawl, I think is what Wall Street is asking. The industrials are down 6% in that 10-day period. Yeah. We've seen the broader market fall 4% over that same period. So while, you know, Washington may call this a trade negotiation, Wall Street is saying it looks like a trade war. We don't like it. We're voting with our wallets.
Is Wall Street really saying that, Jeff? I mean, yes, the market is down, but what kind of economic slowdown or chunk out of economic growth is Wall Street really pricing in here as a result of all the trade back and forth tariffs?
I think that's unknowable. I will tell you, in talking to purchasing managers at various companies, they are preparing for a trade war, but they are always preparing for the worst. My contacts in D.C., and I was just up there recently, tell me that there's not going to be a trade war, that something's going to be worked out, that China can't tit for tat with the U.S. because they don't buy that many goods from the U.S.
So Michael, let me turn back to today's news or the reports that there may be some impediments to foreign investment in American technology firms and vice versa, impediments for American companies to invest over in China. Does that explain why the NASDAQ is down as much as it is today, more than either the Dow or the S&P, and by quite a little standard there, see now down by 2.3%? And is this in any way a time to get in and buy technology?
Tyler, I think, no, it doesn't explain, you know, point for point, because you can't do the math and make it work out. I think your first point earlier, and as you began the interview, was spot on. It's a shift in sentiment. And we know that a lot of the psychology of Wall Street really defines whether we're heading in or out the door and whether we're enthusiastic or fearful. There's a little bit of there's a new cloud of fear. Will it last? We haven't seen any one of these sort of downward trends take over yet. Is this enough of a pullback over a few days to actually step in and buy? Maybe, perhaps carefully, but you have to look at stocks like Netflix that are up over 110 or 15% since January 1st. I mean, we've seen some remarkable runs in these stocks. It's hard to get them down a few percent and think they're cheap.
Another good run we've seen has been in the Russell 2000 index of small caps, Jeff. Certainly domestically exposed or protected from some of these trade tensions, coming off the best run in 5 years, but breaking down today, down 1.7%. Is this still a safe hideout?
Yeah, I think so. I was just on the phone with Amy Zhang, who runs the Alger small cap fund, up about 22% year to date, and I think it's still a good place to be. There are rumors circulating all over the Hill in Washington, D.C. about another shakeup coming out of the White House. One of them is that General Mattis is likely going to be sidelined. I don't know if that's true or not, but it's certainly adding to the worries on Wall Street, along with the trade worries.
You know, Michael, one of your picks very quickly is FedEx. One would think that maybe FedEx would not be a beneficiary of trade tensions. Why do you like it here?
You know, FedEx has had a very tough year. They're looking still for 11 to 15% growth year over year, selling at 13 times earnings. I like to buy stuff that hasn't done much. J.P. Morgan's another name, but I think there's real value here. Fred Smith is as optimistic as he's ever been. The balance sheet is fabulous. When everything else is running crazy, I like to go for things that are a little more solid. I think FedEx makes sense.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.